right, welcome everyone to our next edition, our current edition of our biweekly webinar. I am your host along with Dr. Adebayo Fasanya, Dr. Breathe Easy. I am Dr. George Ozoude. I'm an orthopedic surgeon based out of Houston, Texas, and I'm the CEO of Time Health Capital. It's a syndication investment firm focused on financial freedom and autonomy through real asset investing for physicians. I've been in the space since 2016. I started as a limited partner and have gone on to invest in over 25 deals as a limited partner in multiple asset classes, including multifamily acquisitions, development, in medical office building, in mineral rights, and in agriculture, and looking to expand even more. Currently, I've been the pleasure of having to invest in 4 deals as a co-GP. So now on the general partnership side, in approximately 800 doors of value-add multifamily acquisition. That's about $75 million of assets under management, and looking to expand into other assets and business investments. And I think we'll talk about those things tonight, because different cash flows offer different return profiles and different assets offer different cash flows. We'll be talking about that tonight. But before that, I'll kick it over to Bio so he can do an intro of himself as well.
Okay, thank you, George. I'm Dr. Fasanya. I'm a pulmonary critical care physician. And after years of working in the medical field, right, I think I'm 6 out of fellowship at this point. I recognize the importance of financial literacy, especially for healthcare professionals. During residency, it's not uncommon for you to see doctors that doesn't even know what is Roth IRA or understand how to even get started. We want to get ahead of the curve. And so that's one of the reasons why I started a blog and then ultimately a real estate syndication. So I've been investing as limited partner since 2015. And in 2019, I finally got bitten by the bug to acquire my own property. I started with 8 units, and now we have over 1,000 units, both in that we've co-GP'd in so far or sponsored, and a total asset value of $169 million. My own personal money also is at least a couple of $1 million into all these deals. So today I'm CEO of Dr. Breathe Easy Capital. So we help fellow physicians achieve financial freedom through diverse investment. We don't really specify into a particular asset class like George also. We have done luxury senior living. We've done self-storages. We've done oil and gas deals twice. And we're learning along the way. But our core portfolio is multifamily. So that's where we focus on the most. But if I see a nice self-storage or something else, doesn't mean we're not going to buy it. So today's session, we're just going to explore what kind of different asset classes, what each one of them focuses on, right? Because you have to understand your financial goal before you really start investing. To understand, are you looking for cash flow? Are you looking for equity? You need to know, because that's usually what causes the frustration in investment. When you're looking for cash flow, but then the deal is a construction deal. And then now 3 years later, you still haven't got any distribution. So it's, so that's just a very important topic to discuss.
Okay, I'm gonna share screen because we've talked about this. This actually is one of the core topics in our reasoning why we're doing all of this. So yeah, this is really core values of why we're doing what we're doing. And like Bio said, there's many objectives, and it's good to define them early. And it's okay to change them as time goes on. They can change with seasons, but at least to have a groundwork. But core values, so financial freedom. Why do we do this? For time freedom. Maybe some of us want to retire early. Maybe we want better work-life balance, and therefore our health in relationships, our physical and mental health, because we're hardworking physicians. We want our autonomy, like I said, both with your personal life and freedom to move about, take trips, help other people. You want career autonomy. You want to decide what your day-to-day work schedule looks like. And all of this can be gained by creating wealth. So one of the things that we're going to talk about is financial freedom. And I think that is and you can see different definitions of it, but for me, my definition is having your passive income exceed all of your expenses, all of your day-to-day, month-to-month, year-to-year living expenses. And that you can get from passive income. And when we talk about passive income, we're talking about cash flow, because there's many ways to create the wealth that'll give you all of these things. Yeah, the wealth comes in different forms: time, health, relationships, financial. Money is just a tool to get you some of these other forms of wealth. And so it's not the end all be all, but it can definitely help. There are other types of capital, there are other types of wealth as well that are very important. There's knowledge, there's a wealth of your relationships outside of your immediate family, and that's your extended social network. All of those are important, but we want to use this monetary wealth to access the other forms of wealth and achieve the desired outcomes. We want to replace our earned income, and this is specifically talking about cash flow, with passive income, money we don't have to trade time for to get. Additional passive income can raise your standard of living. It can secure your retirement and increase in capital health and being with specific financial objectives. And we'll look at which ones those are. So other ways to build wealth outside of just, cash flow. You can do it through capital gains. That means whatever money you start with grows depending on the type of investments and the return and the time within that investment. Some other objectives can include capital preservation, and this is very applicable right now. You may want to just preserve what you have if we're in a high period of inflation, meaning the cost of living is going up. So you may want to be able to just preserve the amount of goods and services your capital can afford, your finances can afford, and that's purchasing power preservation. And you may even want tax shelter. All of these are ways to build wealth. All of these are ways to create the life that you want. Different asset classes will focus on different things, and you can grow that wealth either in an aggressive manner, if that's your personality type, or you can do it in a very conservative manner. You can plan for assets that are shorter term. You can plan for assets that are held for longer, like 10 plus years, 15 years. So it all depends, and it'll affect the cash flow and the returns. Some other non-money related, monetary related return that you can build a legacy for your children. You can pass that on. You can help develop a community. You can help give back to the community, charity, international investments. I've done one of those. You can even build up a strategy to retire in a different country, or if certain candidates get elected, you can, have an escape route, an escape plan. You can have a philosophy like green energy, or you just don't like centralized monetary policy and you want to escape and build your wealth outside of centralized policy. So all of these are reasons. Now, these are the asset classes. You have a bunch of different real assets, and I'm not talking about anything paper assets. That's stocks, that's bonds, that's Forex. This is all tangible things. We'll talk about the cash flows that you can get from single family, multifamily, oil and gas, storage, retail, office, medical office, which is specific. You can do hotels. I'm in farmland. You can invest directly in commodities and precious metals. We talked about storage and ATMs. These are all alternate types of investing. And Bio is also invested in senior living as well. So let's look at these. In single family, it highlights a long-term appreciation. Usually when this is a long-term rental, it's not necessarily a huge cash flow play. Instead, there's short-term rentals where you actually have higher margins, where your cash flows can get up to about 25%. And that's when it was really in its heyday, like 2-3 years ago. They may be lower than that at this point, but usually it's more aggressive double-digit cash flows for short-term rentals. Long-term rentals, it's definitely a lower single-digit cash flow. I think that's more of an appreciation play, so that can impact where you choose to allocate your capital. You can still invest in wholesale and fix and flips where there's no cash flow at all. This is more of a appreciation. You're flipping it, buying it for one price, selling it for a higher price. Same thing with developments. You can have single family home developments. You can do them one at a time, or you can do them in a development like a subdivision or a small group of them, but still there's no immediate cash flow because there's no tenants. This is something you're going to have to wait on. You develop it, maybe it takes 6, 9 months. And then if you fill it up and hold on to it, then you can start developing cash flow. But that's going to look like this long-term cash flow for long-term rentals, which is a little bit lower. Then there's multifamily, which is definitely split into acquisitions versus development. You still have the same dynamic as we saw in the previous slide. But here you're starting to get a little bit more cash flow because you're getting economies of scale. I wouldn't call it aggressive. I always describe the type of cash flow that you get from multifamily, like 6 to 10%, depending on where you are in the cycle. If the cycle is at its very beginning of a bull run, say 2011, 2012, then you're going to see double digits, 10+% cash flows. But in the cycles like we are now, most multifamily deals are going to offer about 6 to 7% cash on cash return. So it's something to keep in mind. You still get the benefits of the other ways to build wealth, but one of the biggest things is the conservative cash flow here. Development, again, it's longer. It's 18 months, 12 months before you can think about cash flow because it's being built. It takes a lot longer to build out a large multifamily. I think there in the acquisition side, you can split them up between a larger multifamily, like 75 units and above, versus a smaller one. And the smaller ones, 5 to 75 units, you may be able to get a little bit more aggressive cash flows. And that's because usually you don't have as many investors. It's usually either a small group of JV partners, 4 to 5 of them, or even an individual investor. So inherently, you're going to see a higher percentage of cash flows because you're keeping a bigger piece of a smaller pie, a bigger slice. Then there's oil and gas investments, and these traditionally offer very high cash flows. We're talking 15+%. And this fluctuates with the price of oil and gas, but when the price of oil is very high, these can get even up to 20+, 30+% cash on cash return. Now it's a little more risky, and that usually is the trade-off, but that is something to keep in mind. If you have a higher risk tolerance, you can potentially pursue these higher cash flows, especially where we are headed in socioeconomic and geopolitics today. Most people are anticipating higher oil prices, higher cost of energy going forward in the next few years. Storage, there's aggressive cash thinking about alternate classes, this could be a good source of passive income that's more aggressive than your typical multifamily. I'm in agriculture. It's like development. Usually when you're dealing with some kind of agriculture, you have this carrying time where you have to wait for the actual product to produce. So I'm in investment right now that takes 4 years before it starts generating cash flow. But the unique thing about this is more long-term hold. Remember that slide we had about long versus short term? Usually if it's an agricultural play, you can have 20 to 25 years of cash flow. It may take 3 or 4 years to get started, like the one I'm in, and it has a ramp up period, a peak period, and then a slower ramp down period. But yeah, you can see 10 to 15% cash on cash return with certain agriculture investments. Retail and office, I don't personally have experience with this yet, but my understanding is a little bit more of a conservative cash flow play. You have more of a stable. Go ahead, Bio. You had some take on that?
Actually, I was going to say this slide was before this year, this table.
Yeah,
Unless it's medical offices now. But yeah, but usually if it's triple net, with triple net, if they are
less risk.
paying and also maintaining the property, you literally have nothing much to do
Right.
as the owner. But usually the return are lower. But yes,
Right.
but usually if you can get somebody in there, you can get 10 years contract with rent escalation. So my office that has 5 years in it, I'm like very peaceful. But then the problem is that once that 5 years come around, now you're stressing again because you either have to renew them and if they leave, it might be difficult to get someone else. Yeah, everything has its own plus advantage and disadvantage, but it is definitely conservative more.
Yep.
Overall.
Yep, you'll see that trend. The more risk, the more higher cash flow. So I do think medical office is different. Based on my experience, I think specifically you can invest in the operations as well. That's how I invested in it. I think if you invest in the real estate, it's more of a conservative play because medical office tenants are fairly stable and you can run the triple net model. But you can even invest in the operations, and that's a little bit higher of a risk. And therefore, I've seen maybe the most impressive cash flows, cash on cash returns I've seen in my experience has been from medical office operations. I invested into a surgery center and you can see a high cash. And Bio and I were just talking about investing into private practices, acquiring them as businesses and increasing the operational efficiency. I would say, based on my experience, 20, 30% is what I've seen on this type of investment. By any ideas on that one?
Yeah, medical offices. Oftentimes, I think there are situations where you have to actually work in the medical office too, or surgical center. So it's difficult to delineate the actual cash flow because you're also working in it. So yes, but you will make a lot of money if it works out. It's also risky, right? Because of the operations part of it. It's also labor intensive. So it's all about, with investment, it's all about how much work are you willing to do. So if you really want it to be completely passive, then you're going to get lower return overall. If you want to be semi-passive, which is where I stand now, because I'm actually doing syndication, right? We say passive, but it's really semi-passive for us, me and George. So because we actually have to operate. But the medical office, it is a lot. And the same thing with senior living. They're actually very almost similar. I can talk more about senior living because we don't couple and my mentor actually operate 5 of them. The break-even occupancy for senior living is about 40%. So that's where it's so great. For most of our multifamily, 50% will be the break-even occupancy, right? So then after that is when you start making some profit. But if you have a business that has 40%, is what the break-even is. So if you're 80% occupied, you can think about the cash flow. So yes, but it's also the same thing. It's very labor intensive. It's almost like you're running 2 business because you do we did the syndication to buy the property and then constructed it. It was in construction. And so that's another business. Construction by itself is a new business on its own. And then after that, you now run getting people in, hiring people, almost like running another business. So it's almost like you're having 3 or 4 business in one. So it's definitely labor intensive, but it does have aggressive cash flow for sure.
And so these last 2 are more like businesses. And I think when we first made these slides, Bio probably had some businesses I think he's done, but I'm starting to learn more about just businesses, especially because these small businesses run by baby boomers are becoming more and more available as they retire. And some of them are just cash flow intense. These probably are one of the best ways to increase your passive cash flow, your overall passive cash, your aggregate, and get to whatever number it is to achieve that financial freedom. If you have the tolerance, because why always the risk goes up, right? It's not as risky to just acquire a 90% occupied multifamily building. But now you're taking over a HVAC company or a DME company, and that requires expertise, and you have to solve for that. If you don't already have those expertise, you have to figure out how to bring the people in to keep the business strong and the quality of the product and the service strong. But if you can do that, Bio, what can you attest to? What are the cash flows that you see from business acquisitions?
Yes, me and George, don't judge us, but we talk about the path to $1 billion. So we finally come down to 2 ways: buying businesses, buying and selling, essentially, or venture capital, do a startup. Real estate, all this other passive income, they will get you comfortable. but you have to invest in a large volume. And that's okay.
That's a
You get you
slow
to
game.
financial
Yep.
freedom. But
Right.
then once you get financial freedom, you can take more risk and you can start being like, okay, fine, I have this $1 million. I'll acquire a few businesses and see what happens. So that's what I've seen. So in terms of some of the ones, the successful ones, of course, I opened a staffing company that after during COVID, it was making money. That was just opportunistic kind of a business in which that time staffing company was doing great. You get $130 from the hospital, and then you pay the nurses like $70. So the margin was very high, sometimes almost double. And then I had a car audio company, put 85K, got my 85K back within the first year. And then we start making about $80,000 or so every year. So it is, but then you have to do meetings, somebody have to quit on you, somebody try to sue you. It's a lot of intense work and anxiety because your main employee, will suddenly quit and suddenly you have to scramble. So it is, yeah. So anyway, but it's the best part because you can grow it and then sell it. I have our business analyst, Richard. We've been trying to get him on the web. He grew a business from $0 to $50 million and actually got an offer for it already, a lab company. So it just can happen like that. And then you can choose to continue to grow it or you just exit. But yeah, business, but if you have the energy for it, you gotta have the energy and the risk appetite. And venture capital is more riskier than buying businesses, right?
Probably the most risky you can get.
Yes.
One in 20 is gonna make it. But that one is gonna make up for all the 20 that you invested in. But that's a good example of something that you have to wait for. That's not really cash flow. That's not going to give you return like that. It'll only help pay you off at the end.
If they make it to IPO.
For awareness, you can invest in commodities. I'm in mineral rights. I've seen really good cash flow from it. It's something that's not maybe quite as well known as oil and gas. I've been in it for 2 years and I've seen average of 10% cash on cash return. And I think I still count it as aggressive because it's like oil and gas, based on the price of per barrel. Truthfully, year one was like 19% cash on cash return. It was like 18, 19%. And then year two, when the price of oil went down again, it was more 2% cash on cash return. I do think that's going to swing back up again. Like I said, the outlook for energy I think is going to go up, but they can give you the 15, 20% average cash on cash return if oil price is high. It can get really aggressive with very little minimal risk. Precious metals worth. Yeah. Oh yeah, go for it.
Yeah, for oil and gas, we just wanted to add to that. Yes, our first 2 years, same thing. We got 19%, 20%. At that time, I was already doing my calculations of how I'm going to make $10 million. But by the time it was third year came around, oil price was 120 for a while. It was awesome. We were like making hand over fist. But then it went down to $80. So now we're settled around 3%, 4%. So you have to be, okay with a little bit of volatility, right? So when you put the average, it's still good, but some people entered when it was the 3%, right? So they just started their journey. So then it will put a bad taste in their mouth. But overall, I think also it has the W-2 tax advantage, which is something that it's different from every other asset class in that. So you don't need to be real estate professional. So first year I put 100K in it and I got 90K in depreciation immediately. And then I put another 100K, got another 90K. But then you're stuck now because now you just need to keep rolling that depreciation into each other. I think it's something to consider. So definitely riskier than multifamily, but if you're gonna, there's no way around it. You either want a higher return, you're gonna take higher risk.
Right. I think it's an important point to talk about tax shelter because in my mind, that's actually effective cash flow. It's more money you save, even though it's not technically the additional money that's left over after you've paid off all your expenses and your debt service. That's the true definition of cash flow, but it's still money in your pocket. And
Yeah.
so that's windfall one way or another. And yeah, I think that's a very important aspect to point out the tax benefits for oil and gas.
I did the calculation, right? So if I put 100K in, I got the 90K. So it can turn out to be about $35,000 or so that I end up saving. So that's 35,000. In my mind, I was like, okay, so my money in this deal is only, I know maybe that's not the best way to do the calculation. In my head, I was like, okay, so I have only 65K left in this deal. And then the first year I got like 21% lucky year. I'm like, oh, okay. So now I only have 45 or so left. Second year I got another high and I'm like, oh, only 20% left. So even now, when I get like 3%, I wasn't too upset about it because I'm like, okay, fine. Even if I lose everything now, I only lose 20%.
Yep.
So I don't know. I just think of it that way in my mind. So at least my goal is to get my money back at first. And then there's still that potential to exit. And the exit is usually like more like 3.5x for oil and gas. It's higher. But of course you can lose the rest. So
Sure. I also wanted to talk about a couple of points specifically about what it means to understand the cash flow of a multifamily investment. A lot of times you'll see on offering documents, you'll see the one number or a range. You'll see 6 to 8% cash on cash return, average. But you have to just keep in mind that's an average. And if you actually look at the underwriting, you want to be sure you're seeing how much cash flow you're getting by year 1, year 2, up to year 5, however long they plan and project to hold it. A lot of times the cash flow in the beginning is going to be a lot smaller than that number that was presented on the documents, on the offering. And that's by design. That's usually when you're putting money into the deal to renovate it. And therefore, there's going to be smaller cash flows before you raise rents or whatever your business plan, before you lower expenses. And then as the deal goes on, then you start to see it average out. So you start seeing it increase. But I think that's critical because your plan, if you have a financial freedom plan, you're usually in your mind having a number in your head about how much passive cash flow you want per month and therefore per year. And you have to take that into account. It may look different year 1 than it does year 5. And if you have 5, 6, 10, 20 investments, it's not just the even calculation. It's not like you can just take the number that you saw on the offering memorandum and apply that to what you expect to get from year 1. You have to average it out. You have to take into consideration they are averaging it out. The other thing is there's also something called a preferred return. So that cash flow may not even be there year 1, year 2. It may just be held by the general partners. So I call it realized. So you have to take into account what is actually realized cash flow. And that was very new for me as I was an LP. I thought it was like, no, this is what I'm going to get year 1, year 2. But then there were some deals where they actually held the preferred return, meaning that the 8% that I was expecting cash on cash was being held until they had enough money, maybe year 2 or year 3, to catch me up and make sure I get that amount. And sometimes they catch you up all the way at the end of the deal. So once it sells. And so this is effectively zero cash on cash return realized until the end. And that impacts your financial freedom strategy because you're not just counting on the money at the end, you're counting on that money to replace your daily and monthly expenses. So I think it's a caveat that should be appreciated if you invest in deals like multifamily, where it's cash flow on paper sometimes versus realized cash flow. Any points about that, Bio?
you and I, we've done like what, over 20 deals now. So we've seen different things, multiple deals. Sometimes even we have to hold distribution sometimes. And just depend on what's happening with the property. But When I invest, my own goal is to at least make it through to the end, regardless. So as long as they do not capitulate, usually, and if they catch me up, like that deal that you had, they pay you at the end, the 2x, 2.3x. At the end of the day, you are upset, but at the end, you are happy. So also, God blessed us with high income, right? So for me, my own goal is actually not cash flow as much, personal goal. So that's why when I buy personal properties, for me, I may highly leverage it because it's personal. And then I will just renovate it slowly as they go, only knowing fully well that at the end, I will be able to sell it and make $1 million of it. So to me, that's good enough. Whereas, so you just have to know what your goals are. And also, the more you invest, then the more it's diversified the income in such a way that, like you have 25 deals. And at this point, sometimes I don't even plan exit, right? This year, I was just minding my own business, and suddenly one of the senior living is exiting. And suddenly there's $130,000.
There's a
So,
windfall, unexpected
it's going
windfall.
to happen like that too, that you suddenly just, as long as I just keep going, and then over years, right? The one you did 5 years ago, we start exiting, and then you get into another one. And so eventually the cash flow problem will actually solve by
It
that,
will, yeah.
by
You just
exit.
start compounding. I throw it up here just because I'm a precious metals investor. There is no cash flow in it directly. You can borrow against it, just like you can borrow against other collateral, and then you can put that money to work in a good deal. You'll pay interest on the money you borrowed against it, but you'll also hopefully invest in a cash flowing deal that'll offset that. But directly, there is no cash flow in precious metals, and I do admit that. It's more of an insurance play. Same thing with conservation easements. There's no cash flow in it. It's just a pure W-2 tax shelter, and they come under a lot of scrutiny as of late. So I'm not even sure if it's still a viable investment strategy.
Still, you just have to be back in the day.
Conservative.
Yeah, which is part of
The name.
So people, what happens is you buy a land, and then you say, oh, this land, I could have used it to build a 500 unit. But instead, I'm going to use it as a conservation land. And then because of that, I deserve the tax benefit of that 500 units. So it's like that kind of concept, basically, to say what's the best use of that land. And government, because there's no real limit, some people will go 10x. Like you put 100K, and then you're getting like $1 million in depreciation. It started to become ridiculous. So
yeah, it's aggressive.
I think it was rightly. So now my CPA, every time I mention it, he would just stop me right there. Don't even try. I don't know what is it. Taiwo is there? What she thinks? Is she here? No. Okay.
Maybe she dropped. Anyway, this is kind of part of the rest of our talk, but yeah, just identify your why. If it's passive income, financial freedom, then allocate. You don't have to put all your eggs in one asset class, but understand what's a low cash on cash return versus a conservative mid-level, what's a high level, and understand what risks apply to each of those, because you'll get some balance of that higher risk, higher cash flow, and vice versa. But yeah, identify your life goals, the wealth goals, your financial objectives, and then keep all of these different asset classes in mind as you make your decisions.
Yeah,
that's it.
Yeah, the thing I like about real estate is there's actually an article that says there's 100 ways to invest in real estate, just real estate. So you can, even within real estate, you can be diversified enough if you really want to. If you want a stock like real estate, then you go REIT, if you want, so there's a way. So, so that's my video. Okay. We have questions.
Yep.
So we can answer some of those. And then if you have any questions, type it in the chat. There's not a lot of us, so you can actually raise your hand and come off video. But let's answer this first.
Do you have a good resource for cash on cash benchmarks by industry and geography?
I don't have a specific resource because we're mostly in the Sun Belt. And oftentimes, especially for many of these real assets, you should really know, especially real estate, know your area. So that's probably the most the best, that you have like few geographic location, let's say 3 areas. For me, it's always been Arkansas, Oklahoma, now Texas, Houston. And if you're going to do something in another state, oftentimes you find someone that lives there. So when I do deals in Houston, I prefer to do it with George or Raj or someone that lives there to be the sponsor. So they know the market, they know the benchmark. So that's how I get by with that. Anything,
Yeah.
George?
Yeah, very market specific. I think this concept of primary versus secondary and tertiary markets applies as opposed to east-west. I think it's more primary, secondary, tertiary. And that's just a factor of supply and demand, a factor of the cap rate. You can start seeing kind of the trends. Like you can see what you can expect in a Houston market versus a maybe say a Nashville market versus a Fort Smith market. I don't know if there's an actual dedicated resource though. I think that's your main question is, has someone compiled all this information? It's definitely something that changes with time, with the market. So I'm not aware of any resources that specifically compile all that data. It's more of a kind of a thing where you're just around it more. You're seeing a lot of different deals and you start developing an awareness of what the cash on cash returns are based
I
on
think
submarket.
there are some syndicators here. Billy, I don't know if you have anything to add, if you have those resources.
We'll definitely look for them. I'm definitely going to look for them, see if there's something out there, but I just off head don't have any awareness of anything.
So the second one says, did you buy ETFs or the precious metal directly? If direct, how do you store safely? So that's your question. I'm not
Yeah,
I'm not a
so
precious metal guy. They're not ever going to get me to buy precious metal because I just believe in more of aggressive play, maybe based on age also. Maybe in my 50s, I'll buy some precious metals.
yeah,
So go ahead.
I'm in both. I've gone directly from exchanges and they'll deliver it to your door. You can choose to store it in your house. You can choose to store it at a bank. There's vaults that you can store it, but all of those have pros and cons. So it's just which one you're comfortable with. If you store it in a vault, that's a third party, right? That's you, your gold, and somebody's in between it. So you have to trust them. They have to be reputable. I can give recommendations because I know a lot of folks in the space, but you storing it at home is also risk, right? Do you have the password to your safe? Can you keep it? Can it get robbed? Yes. All of those are potentials. You have to weigh those pros and cons. And yes, I'm in the ETFs as well. It's particularly the mining ETFs. I invest in, that's really the only stocks that I invest in is like some kind of commodity mining stock. And this one is particularly for gold. And it's a combination of all the large and the small miners, and it makes a dividend. So it actually has cash flow in it. It is a cash flow play. It's about 5%, 3 to 5%. So it's not high, but it is a cash flow play in a stock. So, and I recommend if you buy any stock, yeah, look for ones that have dividends. It's not possible all the time, but it's nice to get something. I call it make them pay you to own it. If direct, how do you store it? Say, okay, yeah, we answered that. Billy says you guys hit the nail on the right on the head. It depends on the market and change which changes so often. Yep. Okay.
Any more
Thank you guys.
questions?
Yep.
Addition? Come on, guys. There's a lot of
Comments.
professionals. And Taiwo is here. You want to talk to about consumer easement as a CPA?
Hello guys, Dr. Chris Oji here. Can you hear me?
Yeah.
Yeah, I am not on camera, so saving my battery. Nice presentation, by the way. Well done, guys. Do you mind throwing a bit more light on the oil and gas sector and what the current realities are? I met this guy 3 weeks ago on a flight who was into it, and he a lot of negative review of it, and it looks like the risks involved in it appear to be on the was a word here on the emphasize. So you mind throwing a bit more light on that, please?
Yeah. I can't hear you properly towards the end. Can you talk
Okay,
louder?
so yeah, I was saying that I was asking if you could throw some more light on the oil and gas and how really risky versus what's the opposite of risk, beneficial it is.
Safe.
The recent evaluation I got from somebody who has been in it has been quite negative. So throw more light, please.
I mean, I can, take that because I've invested in 2 funds already. So right now in this particular current markets, it's riskier overall. One is that, first of all, it's in between changing of political climate. We don't know which direction, and one could go, we could make you 20, 30%, and the other one could basically bankrupt your deal. So that's how much it's so contrast. And then there'll be volatility. So if you're trying to exit, it will be difficult. Many people are waiting. Even if you get a new president, you're going to wait another year or so to see what are their policies. So that's one. The price of oil also, I've not seen it in the 3 digits for a while now. So that's basically depressing the return. So also oil and gas, there's so many scams in the oil and gas industry. So I would just say, first is at least know that these people are real, right? So that's the first thing to make sure, because 100% of zero is zero. So that's one almost happened to us, right? 2 years ago, Judge. So we did due diligence, we met this person, and somehow we found out SEC violations and things like that, and we found out it was just
Ponzi scheme.
Yeah, it was a Ponzi scheme. So, we didn't invest, thankfully, and we didn't get investor in it. But so that's one. And then this other part of it is cash flow is you can get 20 now and then 3 next. So be ready. So you're not, so if you want stable, you stay with like things that are like 8%, 7% returns. So yeah, I would say it's risky right now. In fact, I have paused our fund, and we do it every year. So since January, I haven't really pushed the oil and gas that much. Some people still call for tax benefit. You have to know that you're getting something specific from it. Some people are saying, look, I just want the tax at least benefit right now, and I'll take that risk. So just do your due diligence. Make sure you do the team very well. You visit this place yourself. Judge visited King, even though they've been around for 30 years. Many of our partners visited. So yeah, so the short answer is, I say the risk is higher now than it was a few years ago.
So I just wanted to talk about funds because the question referred to that, but just in general, funds, you have the individual investments that you can invest. Somebody can just offer you a specific apartment building to invest in. Other times you can have groups that put a fund together and invest in 10 of them. And this actually has an impact on the cash on cash return. Typically, the larger funds are run by very experienced investor operators with a track record and reputation. And therefore, it's perceived as less risky for that reason, as well as it's like investing in an ETF, right? Where you have multiple specific assets in a basket, and therefore you disperse the risk across the 10 properties. So if 2 of them don't do well and the other 8 of them do great, your overall performance is still good. And therefore the risk goes down versus just investing in one-off. And therefore you typically see lower cash on cash returns compared to the individual investment itself. So that's something to keep in mind. You may see offering documents that say 5% cash on cash return or 4%, but it's a 10 property, fund. And this is why you're decreasing your risk. Therefore, your average cash on cash goes down a little bit. It gets made up on the back end. It's more of like appreciation once they sell and wind down the fund, then you get the overall return. But as far as your cash on cash, it does impact it.
Yeah. Also doing funds, you're basically trusting them. So basically, once you invest into the fund, you don't know what you're actually investing in completely, but you get a generality of it. So if they say oil and gas and anything related to oil, so they might take that money. Instead of going and drill oil, they might go and do mineral rights. They might go and do something else with it. because it allows for that. So if you're absolutely saying, I want this particular investment, it's probably better to just invest directly into into specific fund that's very specific to that asset class.
Yeah, like it's only going to be multifamily, or it's
Yes.
only going to be
It's only going to be
storage.
oil and gas.
Yeah.
So otherwise you're going to end up doing, so there's all these other questions. So I have to answer a page.
That's fine. The next one's precious metals. Actually had a question. How much should you initially invest and not be scammed? I don't think it's related to how much you invest, but in general, there's that overarching rule, never invest more than you can afford to lose, definitely. As far as like reputable companies, this is a due diligence thing. You have to ask around, find out who's already invested in it, maybe on some community chats, on some platforms. You can go to precious metals conferences. You can attend them and talk face to face with these operators, these CEOs of these exchanges. And that way you're dealing with a reputable company. This is similar to any other asset class. You do your homework by just networking and getting out there. You can go online and look at business site, what do they call it? The reviews. And there's websites out there that validate a company, make sure they're legitimate. I can leave in the chat the name of reputable ones that I've used already, and I know they've come through, so they're reputable based on my experience. And so, yeah, it's not really related to how much, it's just doing the due diligence. And I think a small amount is a good way to start with anything. And then as you get more comfortable with it and as your wealth grows, you can allocate more, you can shift and redistribute your allocation as you see fit. It's an insurance play. It's going to sit there. It's not going to generate cash flow. I honestly do think it'll generate wealth because it will go up with inflation. It'll go up a lot with inflation. It may take a while. There may be long periods of flat growth, and then it usually goes up really high because it catches up to all that inflation over time. So I do think it's a good store, and I think it's tried and true. People will go back to it no matter what, just because of the track record to some degree. Not saying all money is going to flow into precious metals, but I think to a large degree, you can see this by the geopolitics. If you follow it, the biggest purchasers of gold have been central banks across the world. So they're buying it for a reason. It'll be here. It won't go anywhere. It's just a matter of how much.
Since the dawn of time, gold has been around. Yeah. So what do you think about other things? People also store ammunitions and stuff like that. I have doomsday friends who they literally store not just precious metals, like different things that I feel like people are gonna need when everything fails, a situation that you can trade with.
That a few years. Oh, sorry, I got frozen.
Okay, I'm saying, like, what about other things? Like some people, like the doomsday scenario, right? Some people buy ammunitions and lead.
Lead, yeah, that's the precious metal. No, I think it's true. I think you should have a store of the basic needs, right? Maslow's hierarchy. You need food, you need water, you need energy. I don't think that can be more true than some of my Houstonians have experienced when we're out of electricity. Like 2 million people in the city were out of electricity after a hurricane for weeks, which is just mind blowing. But maybe it'll be good to have gas and a generator, some real tangible things that you can use. You have food that you can eat that you don't have to cook to prepare. But yeah, I'm a prepper too. I prep. I got bags of rice. I think it is important. That's a form of wealth too, you know.
Yeah, but I just know where I'm gonna come.
So speaking of that, can you speak to any investments you made that ultimately underperformed? Absolutely. The investments, not only did they not cash flow, they took my capital, right? Have recently last year exited a deal that only returned 33% of the original capital that all the LPs invested. And what I've learned from it is I need to look at the debt structure just as importantly as I look at the macro big picture. I need to look at what the debt structure looks like. Is it fixed? Is it variable? How long is it? Is there an interest only period? What's the amortization? Is there a prepayment penalty? All those things is what I've learned from the mistakes I made being an LP and just thinking about, oh, the city, Or is it growing? Is there jobs? Is there, because all of those things checked off, but that didn't matter if the debt doubled the interest on the mortgage in less than a year, and now they can't make the deal work. So all my deals that have struggled either have withheld cash flow, have done capital calls, or have sold at a loss. They're all related to the variable rate debt and that impact. So that's what I learned.
Have mostly be G more than LP. I think there's only one the one I shared with you. It was like
Crowdfunded.
family fund.
Yeah.
It was like large
Yeah.
fund, huge.
Yeah.
And it must have been like almost like $500 million fund. One of those big, huge, gigantic one. And the whole thing, they bought single family in California. And so right now, I've received, in the beginning, it was about 4 years ago, I was actually getting good return. The first 2 years, I got like 12% cash on cash. So 24. And then suddenly they're like, oh, we're going to hold. So that was the first sign of problem. It's different if you hold from the beginning and then, you can see the cash flow coming. But if you're doing well and suddenly hold, it usually spell trouble. And it's the same thing. They were not able to do the flip, sell it like they have planned to. So right now they send a letter and are telling us that basically they're hoping that we get at least another like 80% just to get our money back completely. So I'm still waiting. That's probably the closest I have. All the other ones, they might be struggling, but I haven't had anything about capital call or losing the money. So I'm lucky in a way, I'll say. But it's just
I would say
so it's just like being a surgeon so it's law of averages. It's going to happen.
Yep.
There's no way you're going to invest in 20 deals and one is not going to have some trouble. It's just nature of life. You get better at picking and also selecting, but nevertheless, it's going to happen.
Let me see what else. I have a friend who purchases gold or silver coins for her grandchildren in lieu of regular gifts. Yep, that's not a bad idea. That's not a bad idea. A gift that keeps on giving. Lost out on an entire investment based on the debt structure. Yep.
Yeah, in the
Such
past 2
big
years,
lessons.
Yeah. If you've been investing, for example, we started in 2018, right? We were balling 30% return. I mean, I'm getting like 15% cash on cash in some deals. It was too good. And it's weird how suddenly in the past, most struggle is in the past 2 years, maybe 1.5 years. It is what it is. It's a cycle.
It
So
is a cycle.
It's about to end. It's about to start
which
again.
is remarkable.
Another boom.
It's about to start.
Usually lasts another 10 years of fun.
Yeah, 8 to 10 years.
And then just make sure you don't miss. Because you lose, that's one of the problems. Oftentimes, then many people stop, just like 2008. Many people sold up. Same thing with stocks. You sold everything and you're like, oh, you know what? I've been burned. And now they lost all that gain from 2010 all the way to 2020, 2021. That's 10 full years of fun. That even if you're like, I'm talking about I don't want to say somebody stupid, but even stupid people make money. So during that time, but now is where operation matters, due diligence matters. It's almost over though, I feel like.
Oh yeah, it's coming close. All right, guys, we want to be respectful of everybody's time. We're 7 minutes past the hour. If you have any other questions, you can definitely reach out to either of us. We want to thank everyone again for coming tonight, and we'll definitely look forward to seeing you guys on the next one in 2 weeks. So until then, everyone have a great night, and we'll see you then.
Okay, thanks everyone. Take care.